Good afternoon, everybody, and thank you so much for joining us. My name is Laura Ashton, and I'm the head of strategy and clients for WTS Global, based here in Singapore. And I'd like to welcome all of you from across Southeast Asia, and thank you for joining us today for this, what we hope you will find an exciting and stimulating webinar on a very important topic to many of our businesses. Today, we're going to be looking at ASEAN Cross Border Projects, legal and tax challenges for companies doing business here in Southeast Asia. We're delighted to have, for the first time, a collaboration with the German-Thai Chamber of Commerce and other German chambers of commerce from across the region. The topic for today, particularly around projects, is very close to the heart of German companies involved in projects, as well as many of our other clients who are joining us here today. This afternoon, we're going to have a number of experts sharing their views and providing you some, we hope, very useful insights. We will be recording this webinar, so if you'd like to re-look at later or follow up with the slides, we'll be sharing that information with you. You're also welcome to pass that along to colleagues who may not have been able to make the call. Before we begin, I'd like to encourage you as well to remember the Zoom control bar. If you're unfamiliar with Zoom, there may be a few people left on Earth who are unfamiliar with Zoom. Just mouse up to the toolbar and you'll see a Q&A button. We'd very much appreciate it is as we go through the webinar, you could add your questions. We're going to have a significant amount of time left for interacting with you at the end of the session, and we absolutely invite your questions. You'll also receive the contact details of all of our speakers today. So if you'd like to follow up individually within your country, your jurisdiction, you are able to do that as well. Before we get into the content, I'd like to be able to share with you a little bit of background about WTS Global for those of you who are less familiar with the firm. So WTS Global is a leading global tax practice. We have a long association with German business, having begun over 20 years ago in Germany. And since 2003, we've become a substantial international presence. We have representation in over 100 countries. And WTS Global has already grown to a leadership position as a global tax practice, offering a full range of tax services, and we aspire to become the preeminent non-audit tax practice worldwide. We deliberately refrain from conducting annual audits in order to avoid conflicts of interest and really to be a long-term trusted advisor for our international clients. And clients are represented on the call today, and others as well, come from multinational companies, international mid-sized companies, as well as private clients, family offices, and so forth. Members of the WTS Global Group are carefully selected. We apply a very stringent quality review process. And you'll see from the logos on this map some familiar names. I hope that you've worked with some of these firms before. They're very strong players in their home market, yet they come together with a lot of unity with the shared ambition of really building a truly global practice that develops the tax leaders of the future and really anticipates the digital tax world as well. So WTS Global effectively combines senior tax expertise, depending on where you're looking, lawyers, accountants, economists, and so forth, from different cultures, different backgrounds, and offers world-class skills in advisory, in-house, regulatory, and digital, coupled with very strong commerciality and the ability to connect with clients like yourselves as experienced business people. Today, some of the partners who are joining us on the call come from across the region. In a moment, we'll be speaking with Marius, who's the only one here who's not one of our firm members, but he's a great friend of the firm. We'll also have Till joining us from Bangkok, Tommy from Jakarta, Tinesh is joining us from KL, Fulvio from Manila, Irving from Singapore, and Wolfram from Ho Chi Minh City. So you can see that we've got a very strong geographical coverage, and we hope that we'll be able to answer your questions as we dig into some of the interesting topics relating to projects in Southeast Asia. I'd now like to hand over to Marius Maynor from the Thai-German Chamber of Commerce. Marius, welcome, thank you.
Yeah, thank you, Laura, for this wonderful introduction. Yeah, welcome from Bangkok, welcome from the German Thai Chamber of Commerce, GTCC. Yeah, my name is Marius. I'm the Deputy Executive Director here at the GTCC. And yeah, we are delighted to be the main coordinator of this project within the German Chamber network here in ASEAN, and to offer you this unique platform in partnership with WTS Global and its and our member L&P. We have L&P represented today by Till Morstadt, and this is of course also one of our GTCC members. The German chambers here in Thailand, in Singapore, Malaysia, Indonesia, Philippines, and Vietnam have supported this webinar and are representing a total of roughly 2,500 members. Today we have 120 registered for this event, and coming from a diverse background, leading German companies, global players, but also board members of the German chambers here in the region. Today's topic, ASEAN Cross Border Projects, legal and tax challenges for companies doing business in Southeast Asia. This, of course, is something that we are also very familiar with. The German Chamber network here in ASEAN is well established, and in 2012 we established the so-called German ASEAN Business Council, an initiative to support in particular small and medium-sized enterprises in Southeast Asia, providing, for example, information with a regular newsletter, and also acting as a one-stop service provider here in the region for German SMEs, but also doing roadshows, high-level roadshows, consulting activities in Germany for German SME companies. Today, we will learn about the various legal and tax challenges of doing business, and we are delighted again to do this in partnership with WTS partner firms here in ASEAN. And on this note, I would like to thank again WTS Global, L&P, our German chambers here in the region supporting this event, and of course, the most important, you, the audience, the participants of this very unique webinar. So please enjoy this very insightful session with me and with the partners of WTS Global. Thank you very much. Khop kun kap.
Marius, thank you very much. And I would now like to hand the podium over to Till Morstadt from Lorenz & Partners from Bangkok to take us through the rest of the day. So thank you very much for joining us, and please add your questions as we go. We look forward to speaking with you later.
Good afternoon, everybody. Welcome to this webinar. I'm happy to that this worked out, that we could organize the webinar together with the German Thai Chamber of the German Thai Chamber and many other chambers. It's the first event, as we heard, in this kind, and we hope that we can do other events like this in the future. I see we have now 122 participants. It shows that the interest there is there, and that the importance of ASEAN is growing. I think we are all aware of that. It's good to have the chambers on board, and that they also focus on this regional footprint. And as I said, I would be happy if we could do other events like this one. Topic today, as you heard, is cross-border projects in ASEAN. I guess many of you already have experience with it. either on the receiving side, where you were a customer of a machine building company, which sent then technicians over to install the machine on your premises, or you're building machines, installing plants in other countries, sending servicemen out. And probably you are aware that these such projects can be really challenging. They are quite complex. They are not only, you cannot not only look at them from one perspective, you have to actually have a legal view on them, you have a tax view of them, you have an administrative view on them. So what we are trying to do in this seminar is that we break it down a little bit. We broke it down into 4 separate topics, which are the registration requirements for foreign companies if you run such a project. The second one is tax and accounting requirements when conducting business in another country. The third one, a pretty important one, foreign labor requirements. That's getting more and more challenging in Thailand, and what I learned also in other jurisdictions. And last but not least, the taxation of foreign labor, which is from a financial point of view often a very tricky one, because you have to avoid double taxation, of course, because this increases your cost. Each of those topics will be moderated by one of our speakers. I will lead to the first one, and we will at the end of the session have a Q&A. We didn't want to have this after every single topic because there's partially overlapping, and it's good to get the full picture and then raise the questions. So feel free to type in the questions into this Q&A tool. We will go through them, sort them a little bit by topics, and then go through them. So that's basically what I wanted to say about the seminar organization. We have presented to warm up a little poll where we just want to find out who already has experience with cross-border projects, just to get a bit of a feel for it. Please vote on it while I now get prepared to present the first topic, which is the registration requirements. So the first thing what you always have to think about if you have cross-border projects is, what do you have to do in terms of registering there? Is it required that you need any kind of organization there which has to be registered with the authorities? So for example, if you have a machine seller from Singapore who wants to come to Thailand, what does he have to do first if he wants to install a machine? Can he just come or not? In Thailand, there are theoretically 4 different ways of how you can register as a foreign legal entity. You can set up a private company limited, you can register a branch, you can register a rep office, or you can register a private partnership. The last 2 are actually not really relevant in this context, so we're going to focus on the first 2. The most common one for projects is actually the registration of a branch. This is not only in Thailand the case, it's internationally. This is normally what you do if you have projects which, at least if they're lasting longer than 6 months, you do need to register in most countries, and you will have to basically choose a tool how to do this. In Thailand, the branch registration depends on who is actually the project owner. That's something that changed a couple of years ago. They made the registration for government projects easier because they say anybody who won a government project already went through a vetting process, so you don't really need to look too much into it. So if you have if you're involved in infrastructure projects, for example, you can very easily register there, and you can basically you can just go to the authorities and register the contract. This already qualifies for then being able to do the project. Different, and this is also if you work in a second layer, as soon as you work with private entities, this is different. Then you have to go through a pretty long-lasting registration project. It takes about 4 to 6 months. And you have to present a business plan to the authorities, which is then approved. And this business plan actually determines the so-called minimum capital. This minimum capital is based on the average yearly costs you have, and you have to pay in 25% of this into Thailand. and you can use the money. It's basically like a registered capital, but it's intended to make sure that these projects are properly funded. This can be quite a cash flow challenge because if you have a project, say $10 million, if you cost maybe then $8 million, 25% of that is $2 million. So you have to be aware of that, and you have to put it into your cash flow planning, because otherwise you might be surprised that you suddenly have to come up with this amount of money. The alternative of the branch office is actually setting up a company limited, which is then a separate legal entity, and split the contract into a local component where you only do the installation and the local content, and an offshore portion, which is basically the delivery and mostly the engineering, which is done in the home country of the supplier. This one has certain advantages in terms of tax. Registration-wise, it's pretty similar if it comes to the foreign business license, but it is something what you always also have to make sure that you at least think it through. If it makes sense, it may, if it is possible to discuss it with, to agree with on it with the customer, then it makes definitely sense to go through it and discuss it if that's an option to make basically both sides win. As you see, the whole project, the whole matter is actually pretty complex, and particularly the timing can be a big problem. That's the most important part. You have to make sure that that you have the timing in mind. If it's a private project, you will probably need around 4 to 6 months to set up here and be able to bring labor in to start to start the buying process, the local buying process, and so on. So it's pretty important that you do that. So what we always advise our clients is come as early as possible and get information, because the worst thing what can happen is that you run out of options only because you asked too late. So the best is actually to come during the bidding process or during negotiations already, so that you can then bring this knowledge into the negotiations and get find the ideal structure for your project. The next country we want to talk about is Indonesia, which is also not known as one of the easiest ones in the region. So I would like to hand over the word to Tony Hasono to talk about his experiences in cross-border projects in Indonesia. Tony?
Thank you, Theo. Hello, everybody. Good afternoon. A very brief introduction of myself. My name is Tommy Hasono. I'm running an Indonesian tax consulting firm. I've been in this practice of the Indonesian tax consulting for more than 20 years. So during this webinar this afternoon, I will cover the Indonesia. And then with regard to the construction and installation project in Indonesia, as briefly described by Theo, we have more or less similar situation with Thailand in Indonesia. You see in the screen, we have few options of the of engaging a construction project in Indonesia, but it is important to have early planning of this option for you, whether you go with a limited liability company, you go to the branch or rep office. But in summary, having the construction project in Indonesia is rather complex. And for example, on option of limited liability company, you need to set up this limited liability company. However, there is a requirement to have a local partner, and therefore you need to form a joint venture based on the negative list government regulation to set up a limited liability company. And as well as there is a minimum capital you have to fulfill to engage a project to set up a limited liability company. That's more or less the issue with the limited liability company, particularly if you have a project with a short-term period and this consideration to set up a limited liability company. You need to seriously consider what's the issue that I just mentioned. Another option is to set up a rep office, representative's office, the very right side of the screen you can see. Obtain license being foreign construction rep office, you need to go to the Minister of Public Work. That's again, it's not an easy process with the context of Indonesian government to get the license of foreign construction company in Indonesia. In both cases, limited liability company or rep office, you need another business license to engage a construction activity in Indonesia. So in short, there are a lot of requirements need to be considered before you even engage a project, a construction or installation project in Indonesia. Having said that, there are of course potential planning options, particularly from tax point of view, where particularly if we look at the Indonesian-German tax treaty, as we are now, kind of having a background for a German company who is selling equipment to Indonesian customer, and what is the implication if they do installation or construction in Indonesia. There's a very, very good opportunity from Indonesian tax point of view, having a look at the Indonesian-German tax treaty, and for example, you can have the separation of contract between the supply of equipment directly from Germany and local installation contract with the customer. Those options need to be carefully considered, and of course, we need to see what is the some key factor of the project. For example, the length of the construction or installation period, the value of the project, and the customer. So that's more or less the consideration you need to have. You need to conduct before you set up your make decision. What kind of the establishment you need to do for your construction or installation project in Indonesia. Having said that, I guess that's more or less a summary of the Indonesian registration for branches of subsidiary on this construction project. And then I now pass to Tenes to cover the Malaysia. Please go ahead.
Thank you, Tommy. So for the case of Malaysia, just like other countries, we have similar options, having a local company, branch or rep office. We also have LLP as an option, limited liability partnership, but that I didn't include in the slide because in the Malaysian context, that's pretty much used by the professional firms like accounting firms and legal firms and whatnot. It's not commonly used in cross-border projects. So to keep it pragmatic, I've limited the choices to this three key items. To incorporate a local company, minimum one shareholder would do, whether it's an individual or corporate shareholder. We need one local director, but local director doesn't have to be a Malaysian director. A local director could very well be, as an example, a German who has a German citizen who has a principal place of residence in Malaysia. So that is taken as a local director. So a local director does not have to be a local citizen. It can be any natural person as long as their principal place of residence is in Malaysia. So Malaysian companies' corporate tax rate is 24%. There is generally no local shareholding requirement. There is no FIC approval needed. That used to be the case some time ago, but these days that is not the case. You don't need any FIC approval or local shareholding, except for selected sectors such as retail trade and petroleum-related sectors. So generally, most of the sectors, there is no local shareholding requirement or FIC approval needed. Now, the next option is to conduct through branch or PE, permanent establishment of foreign company. Foreign companies are allowed to conduct businesses in Malaysia. Above certain threshold, they are required to register with a branch with the Companies Commission of Malaysia. The threshold is pretty low. So long as the isolated transaction takes more than 31 days, then a registration of branch with SSM is required, or in English we call it CCM. The point here is that, as we know, most of the double tax agreement has 6 months or 9 months as the time threshold for creation of PE. That being the case for tax purposes, separately for company administration purposes, this 31 days rule applies. This is not overridden by the 183 days in the DTA because this is not a tax requirement, but instead a company's administration requirement. The corporate tax rate for branches are 24%. There is no special repatriation tax or whatnot. There is the final tax liability for a branch is the same as a local company, but from a cash flow perspective, branches have a disadvantage because when they bill to their local customers, there would be a 13% withholding tax, which is refundable. So in terms of the net tax exposure, branch would be the same as local company, but they would have a cash flow disadvantage. The advantage of branch is, of course, things move faster. You don't have to wait to get CCM permission or whatnot. So we always say if it's short term, then maybe it's a PE case. If it's long term, usually most companies would most investors would go for local company because they don't want to tie in their cash, right? Now, 13% of your gross could mean, if your project is running at a 20% profit margin, 13% of gross income being held with IRB for 1.5 years means that more than half of your profit is being locked in with the tax authority unproductively, right? So that means a lot there. Then rep office, as usual, we have the rep office scheme that doesn't require registration with CCM, but approval is needed. A minimum spending of 300,000 ringgit, something like 70,000 US. The list of permitted activities and prohibited activities are on the list. I don't want to read them, that you could refer to it. So that's pretty much the case for Malaysia. Even though I didn't put in a partnership here, partnerships are allowed. Partnership could be in a form of a PE, or could be in a form of a incorporated JV and whatnot. So that the legal status then depends. So that's for Malaysia. With that, I pass on to Fulvio for Philippines. Over to you, Fulvio.
Thank you, Dinesh. Good afternoon to all of you. The first question, is there a need to register? That is usually the first question asked, especially when it comes to short-term projects. From a Philippine setting, there is no requirement, but there are things to be considered, including, for example, from a legal perspective, foreign corporations doing business in the Philippines are not allowed to sue, but they can be sued. That's the adverse consequence of doing business in the country without a license. Second, from a tax perspective, if the project is so short that is not more than 6 months, there is no problem because it will not create a permanent establishment or PE and will not be subjected to tax in the Philippines. There is only a need to apply for a tax treaty relief with the tax authority, and the application will suffice. But if a project lasts more than 6 months, a PE is usually created and the foreign corporation becomes taxable in the country. The problem with an unregistered PE in the Philippines is that it is taxed through the final withholding tax system, which means that the customer will withhold on the gross amount of income using the income tax rate. Effectively, the foreign company is taxed at the income tax rate of, which is now 30%, computed on the gross income. As opposed to a registered PE, the tax is imposed on the net income. Now, if the foreign company opts to register a presence in the country, it can do either through a domestic corporation or a branch. There are no significant differences between the two, even for tax purposes, except that in the case of liability, the liability of the branch extends to the head office. That is not the case in a subsidiary. Note also that for subsidiaries, the Philippines had relaxed the rules in the number of directors and incorporators and their citizenship or residency. There is basically no residency requirement now. One last point, the Philippine Supreme Court had recently issued a decision holding that foreign corporations or Philippine companies, which is 100% foreign owned, may engage in the construction business. That is contrary to the position of the Philippine Contractors Accreditation Board, which had been imposing nationality requirement that is at least 60% Filipino-owned may engage in construction business as a condition for the issuance of licenses. This Supreme Court decision cleared the way for foreign contractors to conduct construction activities in the country without worrying any about the extent of their foreign ownership. they can be 100% foreign owned. I think that's all on my part. I now turn over you to Irving of Singapore.
Thank you, Fulvio. Hi, everyone. So I'm not going to go through all the different structure forms in Singapore because I think they're fairly similar to the other jurisdictions that have introduced what's going on over there. I think the issue of whether you're carrying on business in a country or with a country is an issue of degree. So if you're just sending someone to come into Singapore to provide services for a couple of days, that is just carrying on business with Singapore, not in Singapore, so you don't need to register. However, if you do need to register because you're going to be here for a substantial period of time, then usually what we see is that the private limited company is the preferred form for carrying on projects in Singapore, simply because it is easy and relatively cheap to set up and maintain. For example, there's a minimum paid up capital requirement of $1. The shares, you can have a single shareholder, you just need a single resident director. You can easily get resident directors, nominee directors to serve in this capacity for a relatively cheap price. And at the same time, you continue to preserve the ability to limit your liabilities for the foreign parent companies from the risk associated with the project. So the private limited company is generally preferred. And even in the case of a joint venture, some investors may want to set up just a private limited company to act as a party to the joint venture, whether it is in the form of a partnership or whether it's in the form of a public-private partnership, or to just simply use a private limited company as a joint venture vehicle. That's pretty much for Singapore. Let me pass this on to Vietnam. Wolfram, I think you need to unmute.
Sorry for this. Welcome again from Vietnam. Luckily from Vietnam, this is rather easy. Doing a project in Vietnam, no matter how long it takes, does not require any registration, not administrative, not for tax, except it is in construction business. For construction business, you need to obtain an operating license for construction and register a project management office, which takes around 3 to 4 months. And this is only for one project. So if you do 3, 4, 5 projects in Vietnam, you do not need to register anything. If operating many projects, it is recommended to set up a limited liability company, which is the normal way to do business here, the most common way. The challenging part for this is in Vietnam to define the scope of business, because what is not licensed is not allowed to do. This must be done very carefully. In very many cases, companies open a rep office, which is the easiest way, but it is not recommended because in too many cases, the activities of the real activities of the rep office is going beyond the licensed scope of a rep office. And this causes severe tax problems because then it is causing a PE of the represented company in Vietnam. With this, I give back to Till.
Thank you very much, Wolfram. It was actually one of the biggest surprises for me when we prepared this seminar that Vietnam is actually the easiest country to organize a project. It's even easier than Singapore. It shows how quickly this region and particularly Vietnam develop and how quickly things change. But overall, you can see that it's actually pretty important that you get legal advice on before you start business. Every country is different. You have to get the information together, what you have to do as early as possible so they have time to do that. That was basically what we wanted to say about topic number 1. We have now topic number 2, accounting and tax, which will be led by Irving from WTS Singapore. Irving?
Thank you, Till. So just a reminder to everyone, if you do have any questions, please feel free to key it into the Q&A chat. So the purpose of this section really is to discuss some of the main tax and accounting requirements that commonly affect cross-border projects, not necessarily the tax actual tax treatment of the projects themselves, just because they vary so significantly. We're just going to do a broad survey of key areas of tax and accounting requirements. On the issue of registration, and just to emphasize that this is a slight difference from what we were talking about earlier, which is a business registration requirement. There might be a separate requirement to register for tax, even if you have registered your business in a country. Now, in Singapore's case, you don't need to. Once you are registered, you register a new company, for example, you don't have to separately go to the Revenue Authority to get yourself registered for tax purposes. But this might be an issue in other jurisdictions. So you might need to register with the local tax authorities if a new legal entity is set up for the project. And of course, even if you don't have an entity set up, there might also be a registration requirement for non-entities such as partnerships. So in that kind of situation, then it is quite important for you to find out who will be responsible for the registration. For example, in the case of partnership, it is typically common to have one of the partners assigned as a precedent partner, who will then be required to approach the tax authorities and to have the registration done, as well as all other tax compliance to follow up with. So here, I thought I would just rope in my colleague from Vietnam, Wolfram, to just maybe talk about the tax registration requirement in Vietnam. Sorry, Wolfram, you have to unmute yourself.
In Vietnam, as mentioned, no tax registration requirement is existing if just the project is operated. But the reason for this is that Vietnam imposes a withholding tax system. So the foreign contractor must really consider the structure of this withholding tax system and the double tax agreement well before the bidding process. Because if the contract is not matching these requirements, the tax rates applicable are higher than necessary, and the benefits under the double tax agreement maybe cannot be used. So there is no registration, but this does not mean the foreign contractor should not consider tax issues.
Thanks, Wolfram. I think that is indeed an important issue about withholding tax, which I will go to in a bit. So maybe let me just move on to the next area, which is on tax filings. And here there are a few issues to really think about in the context of projects. And one is, in many countries, there is often a requirement for businesses to make semi-annual or even quarterly payments of tax based on estimated revenue projection, and this might have an impact on the cash flow of the project itself. So it's usually one of the issues that you might want to pay attention to just before you, embark on a project in the country. And the other thing is, the distinction between an accounting and a tax year. So there might be jurisdictions where the financial year is not aligned with the tax year, and there may either be a requirement for you to apply for your tax year to follow your financial year, or there's no ability for you to do so at all. In which case, obviously, it means that you need to prepare two sets of accounts, which are both financial and tax accounts, and which can lead to an increase in the cost. And even if the tax and accounting periods are actually aligned, then there might be a situation where the financial and the tax accounting standards are different, and therefore you still need to prepare two sets of accounts anyway. So here, this is where it is important before you go in to a country to maybe, to pay some attention to whether or not there is this kind of accounting tax year mismatch. Let me invite my colleague from Thailand to speak about tax filing requirements in the country.
Thank you, Eric. Actually, the tax filing is that the standard requirements are pretty similar to Europe. You have VAT filings, you have annual tax returns. The VAT filing is on a monthly basis. You also have withholding tax filings on a monthly basis. But this is, I think, pretty much standard. The challenging part is actually the half-year tax, what you have to submit, especially for projects, because you have in 4 months before financial year end, which coincides with the tax year in Thailand, 4 months before the end, you have to submit a tax estimation. And basically the assumed profit, you have to pay half of the tax. If you have calendar year, it would be end of August, you have to pay half of the tax, deducting the withholding tax, which was already deducted by your customer. This, especially in long-lasting projects, can be very challenging because you have a lot of assumptions there. If it's a 3 years project, first of all, you don't know what your final project profit's going to be. Secondly, you don't know how far you're going to be at year end. And the miscalculation or wrong estimation is penalized. If you underestimate, you pay 20% on the underpaid tax as a penalty. If you overpay, that's theoretically not a problem. You can claim it back. Problem is, it's then effectively the problem is you need to claim it back, which comes with a full tax audit, takes normally minimum a year. So it is very important to do this diligently and see that you get I would always rather suggest to underestimate than overestimate, because the penalty is actually doable. But if you have to refund, that's a nightmare, especially at the moment. Thank you, Irving.
Yeah, thanks, Till. I think that's a great point. I think typically that's what we observe in many countries where you are required to do an estimate, and then any refund will obviously trigger a tax audit, and then usually that it becomes a windfall for the tax authorities, because then they kind of assume that people don't want to be audited. So it's always a challenge finding the right balance between over and underpaying.
The longest one was 8 years, I think, we took to get a refund, just to give you an idea.
Yeah. So I think that's clearly something to think about. So let me just move on in the interest of time to the next area, which is on tax records. And here, I think there are 2 areas that I really want to talk about. And one is obviously, as all of you might be aware, there's this increased emphasis on transfer pricing against base erosion. So making sure that intercompany transactions are priced at the right level between related companies. So transfer pricing documentation becomes a very important part of ensuring that transfer pricing rules are adhered to. And countries in the region have in recent years come up with transfer pricing documentation requirements. And this is something that projects will need to pay attention to, particularly where there are intercompany payments involved. And the other thing to, I guess, perhaps think about also is the fact that apart from how long you need to keep the records, the likelihood that you might be approached by the local tax authority to provide information to the local tax authorities as they try to discharge their exchange of information obligations with perhaps the home jurisdiction of the project, the company that's engaging in the project. So that's something to also bear in mind as an issue of sensitivity. Here, I'd like to invite Tanesh from Malaysia to maybe talk about the record keeping requirements there.
Thank you, Irving. So as you correctly pointed out, transfer pricing is a growing area of concern. We have to look at the commercial arrangement. There would, usually in project situation, there would be related party transactions, especially if it's a long-term project, right? For example, if we get a project with a Malaysian customer, but half of the project is delivered out of resources from an European country or another Asian ASEAN country, then that part we need to look into the transfer pricing bit. Most countries have a threshold for transfer pricing documentation. Malaysia, for example, has a threshold of 15 million ringgit as the threshold for related party transactions. So which means that if the amount of related party transactions is more than 15 million ringgit, preparation of transfer pricing documentation is mandatory. If it's below 15 million ringgit, then preparation of transfer pricing documentation is not mandatory, but nevertheless, the transactions are required to be in compliance with arm's length principle. So you need to be able to justify that the intercompany transactions were not overpriced purchases. In the case of PE or projects, normally the related party transactions on purchases. So need to make sure that the purchases are not overpriced. Even if you're not preparing a TP documentation, there needs to be justifications to substantiate that. Documentations are required to be kept for 7 years. Tax audits generally can take place within 5 years, but nevertheless, documentations are required to be kept for minimum 7 years. Another common issue that we find in PE scenarios is that we take care, companies do take care of their corporate tax filing, VAT filing, and so on, but they overlook CBCR filing. So if you have created a PE in a particular country and the group is subject to CBCR filing, then the PE must be reflected accordingly in the CBCR filing, and CBCR notification is required to be done in the local jurisdiction if there is PE in that respective jurisdiction. So that has to be kept in mind in ensuring the compliance check as well. Over to you, Irving.
Thanks, Tanesh. I think that's really helpful, and I really underscored the importance of paying attention to your local transfer pricing documentation requirements, because they do usually carry a much more significant penalty as compared to the non-compliance of general tax documentation that is non-transfer pricing tax documentation that's otherwise required. So something to keep in mind. On to the next topic, and I think perhaps the most substantive topic over here, and that's on withholding taxes. Here, obviously, I think all of us who have advised on cross-border projects would have some kind of pain points with withholding taxes in their respective jurisdictions. Obviously, one of the issues would be if you are making payments such as interest or other intercompany payments to either a foreign parent or a foreign service provider, there's always issues of classification, right? So recently, I had to advise a German client on some services that were rendered in Singapore, which they had an issue of classifying, some challenges in classifying whether it should be classified as royalties or whether it should be service income, because then obviously the tax consequences of that, whether the withholding requirements varies. So that's one of the issues that projects, I think it's quite important for project managers to think about, is that while you are going to be paying some kind of payment to the overseas entity, think about how it should be classified, whether or not on paper it is a royalty payment, and whether local authorities might want to deem it as a service fee instead, for example, and want to impose some kind of withholding tax. And obviously, once you have a withholding tax, you need to think about the rates that would be applicable to the kind of payment. And if there is a tax treaty between the country you're operating in and the home jurisdiction, then whether a reduced withholding tax rate would be might be applicable. I think this topic will be covered a little more in topic 4, so I'm not going to go into too much details over here. Another issue to think about in terms of withholding tax is obviously whether the tax is final. So typically when we say it's a final withholding tax, it means that you cannot go back to the tax authority and say, hey, I'm now going to file a return and I have overpaid in terms of the amount that's withheld. Please give me some of the balance back. A non-final withholding tax, on the other hand, allows you the option to go back to the tax authority at the end of the year to say, okay, if I do file a tax return now, this is how much I would have paid in taxes. This is how much has been withheld before. It's more than what is sufficient to cover the actual tax liability. Please give me a refund. So finality of withholding taxes can have an implication on what is final tax that's suffered, something that tax advisors would should bear in mind. And the other thing would be what is the filing deadline and when is the payment deadline for your withholding taxes. And obviously, just because you do not want to be in a situation where you don't meet the filing deadlines and payment deadlines and be penalized for it. The other big source of, I guess, a pain point really is repatriation of profit. So if you do decide to either set up a branch over in the jurisdiction or to set up a company, then there's that issue of how do you get the profit back to the home jurisdiction. There's typically a withholding tax on dividend payments back to the home countries if you do decide to set up a subsidiary. But if you don't, if you have a branch, one of the issues that might happen is that you might be subject to a branch profits tax on either the actual or the deemed remittance to the home country, and that can have usually results in a less favorable tax consequence to the taxpayer, as opposed to just simply paying withholding tax on dividends, if any. For example, in Singapore, we do not impose any withholding tax on dividends that's paid by a local resident company under our one-tier corporate tax system. So obviously, having an appreciation of how dividends and how branch profits are taxed in the country you're operating in can, I guess have a bearing on the form, the legal form of the of business that you want to carry out in that jurisdiction. Okay, so here, allow me to pass the mic to Tommy from Indonesia to maybe talk about the withholding tax situation there.
Thanks, Jeffrey. Thanks, Jeffrey. So in case of Indonesia, the withholding tax is well known for its withholding tax system. As Irvin has covered, the payment of to non-resident, which is basically subject to local withholding tax of 20%, or we look at the DTA tax treaty within the country and the home country, particularly for the construction and construction installation service. It's subject to final withholding tax, as mentioned by Irvin, Indonesia, in the rate of 2% up to 6% from the invoice value. So it's the rate of 2%, 4%, 6% depend on what kind of service are delivered during this construction. It could be engineering, construction, exclusion, or supervision, subject to different withholding tax. This withholding tax is final, as mentioned earlier. That means that this withholding tax represents the annual corporate income tax liability of the branch or the PT company. And apart from that, there will be a branch profit tax if they are PE at the rate of 20% based on Indonesian domestic tax regulation, but the rate can be reduced by tax treaty to 10% to 15%. As well as for the PT, a local liability company, the profit repatriation in the form of dividend, interest, or royalty is subject to 20% withholding tax based on Indonesian tax regulation. But this rate can also be reduced based on the tax treaty between Indonesia and the home country. That's more or less the brief summary of withholding tax in Indonesia. Irvin, back to you. Thank you.
Thanks, Tommy. So I've been asked to speed up a little because we are running a little over time. So let me just briefly just talk about the audit and the accounting requirements. I guess the issue here is to think about whether you need to even have audited accounts. Bear in mind that countries usually have some kind of some small companies exemption rule. So if your company is not beyond a certain size, you might want to just seek just avail yourself an exemption so you don't audit your accounts. And the other thing to think about is what are the requirements on how the accounts are to be prepared. Do you follow local accounting standards, or there's some kind? Are you able to use the home jurisdiction's accounting standards? And this can have an impact on long-term projects and the recognition of their income, which in turn has an impact on the profitability. If I could just pass over to Philippines, to Fulvio in Philippines, to maybe just give us a quick thoughts on accounting requirements there.
Thank you, Irving. Actually, there's no such thing as local accounting standards. While the Philippines has its accounting standards, these are actually adapted from the International Financial Reporting Standards issued by the International Accounting Standards Board. The Philippine Financial Reporting Standards and the Philippine Accounting Standards are the current set of generally accepted accounting principles here in the Philippines. As to accounting requirements, businesses in the Philippines are also required to maintain books of accounts, which may either be manual or computerized. Either way, these books are required to be audited by independent certified public accountants, and such audited financial statements are required to be submitted to the Philippine Securities and Exchange Commission and to the tax authority and other regulatory bodies. To answer the question, there's no difference between the accounting standards used in the Philippines and those that are used mostly by other countries. So there could be no differences between the treatments done in other countries and those treatments done in the Philippines. Thank you, Irving. Back to you.
Thanks, Fulvio. So I guess with that, we will just move on to the next topic on foreign labor requirements, and we'll leave it to Wolfram to take us through that. Wolfram, over to you.
Yeah, most projects need that foreigners come to our countries for doing a major or smaller part of the work. And now under COVID-19 regime, it is at least in Vietnam, is almost blocked, and it is very difficult in all countries. We do not want to cover this today because it is very differentiated, and next week the picture will be different from today probably. So we just talk about the situation, not thinking of COVID, or let's say after COVID. Yeah. In most countries, we need a work permit, a formal decision like a work permit. Has a different name sometimes, or a formal decision on a work permit exemption. And additionally, we need a visa. So I begin with Vietnam, and then I will hand over to the next country. But in Vietnam, we have also the option of working without work permit, which is very convenient because without any registration, without any decision except internally in the company, it is allowed to work in Vietnam for up to 90 days in a year. The assignment must not be longer than 29 days. In case of a technological incident or breakdown or something like this, a foreigner can come for up to 90 days, or if the incident is solved before, then this option ends. In all cases, a visa is needed. This is a working visa or a business visa, depending on the case. So in Indonesia, we have a bit a different situation also, but also including the option of working without work permit. Tommy, can you please introduce this to us?
Thanks, Wolfram. Yeah, in general, in Indonesia, there are two requirements to work in Indonesia as a construction project. One is to obtain working permit from Minister of Manpower, and the second one is to obtain the visa for the immigration office. So these two requirements. Very recently, the government issued omnibus law on the 2nd of November, only a couple of days ago, and the omnibus law provide exemption of obtaining working permit for certain area, as you can see in this screen, for director who holding a certain amount of shares, commissioners, which is representing the shareholder, a person who is needed for the halted production activity due to emergency, vocational activity, technology-based startup, business visit and research. Those are the area as per the most recent regulation get exemption of the working permit. But as with regard to the visa, it is still required. This visa application goes to immigration office, and you need whether you need a business visa or cultural visa. So most of those the construction will require this business visa, and that should be obtained to the immigration office. That's for the Indonesia. It's quite common, I think, the process. And then by this, I pass to you, back to you, Wolfram.
Okay, thank you. Malaysia, Tanish, can you introduce your regulations to us, please?
Sure, pleasure. So just like most other countries, we have the work permit and we have the business visa as well. Interestingly, we have an additional feature which is very directly relevant to the topic today: cross-border projects, let it be installation projects or whatnot. That is a scheme called Professional Visit Pass. So Professional Visit Pass, as the name suggests, is available for only certain professionals, lecturers, researchers, technical advisors, as well as installation and fixing of machines, or maintenance expert of machinery and equipment. So a lot of cross-border projects happens for installation and fixing of machines and maintenance, and hence professional visit pass is commonly used for that purpose. This is not available for construction industry though. And the way professional visit pass works is that you do not need a local employer. You do not need a local employer. The foreign worker can come in under the name of the foreign employer, so long as there is a local guarantor who undertakes to make good if taxes and whatnot are not properly complied with. And this professional visit pass is available for both foreign companies without a branch in Malaysia, as well as those with a branch in Malaysia. When you come under the professional visit pass, it does not necessarily mean that the employees are subject to personal income tax in Malaysia. it depends on the number of days that they spend in Malaysia. It depends whether or not the foreign company has a PE in Malaysia. So the very fact that you're using a professional visit pass does not necessarily mean there's tax exposure, but it is a very convenient way to send foreign labor to Malaysia for installation projects and whatnot. Obviously, the time limit is quite limited. It's maximum 12 months for each person. So that's the unique part in Malaysia. The other bits are pretty routine and consistent with the other countries. What you from?
Yes, thank you. The Philippines, Fulvio, can you please continue?
Yeah, thanks, Wolf. As in the case of other countries, the basic requirement for a foreign employee to work in the Philippines are the alien employment permit, which is obtained from the Department of Labor and Employment, and the work visa. We call it 9G visa, or the pre-arranged employment visa, which is issued by the Bureau of Immigration. The alien employment permit is needed to obtain the work visa. Now the question is, are there instances where foreign employees will work without a work visa? Yes, there are at least two. One is when a foreign employee is required to start working immediately while the 9G visa is in process. A provisional work permit, a PWP, may be issued by the Bureau of Immigration. This means that the PWP may only be issued to foreigners who are already issued alien employment permit and work visa application still pending approval. The PWP can only be issued to those with tourist, health, or business visas. So the tourist visa is always necessary. PWP is valid up to 6 months visa, so the visa must be secured within that period. The other instance, the second instance where foreign employees may work without work visa is in cases where the contracts has only 6 months or less duration, in which foreigners are required to apply only for special work permit, SWP. They can work under a tourist visa, provided that the validity of the contract is only up to 3 months, which is extendable to another 3 months, could be extended to another 3 months. So those are the instances where foreigners can work in the Philippines even without the required, the usual required work visas. Thank you. Back to you all.
Thank you. What are the requirements in Singapore, Irvin?
Hey, Wolfram. So yes, we're very similar to Malaysia. We have a short-term exemption for certain types of activities, and one of which is relevant would be specialized services that relate to new plants and equipment. So if you spend less than 90 days in Singapore, or rather up to 90 days in Singapore, providing specialized services for such new plants and equipment, then you do not need any work pass. And if you do spend more than 90 days, or if you're doing something that doesn't fall within the scope of an exempt activity, then you do have a range of work passes that you can look at, which are generally classified by the skill level that is required, but practically speaking is really a function of the salary. So, you know, for the S pass, which is meant for mid-level skill, is you need a minimum requirement of at least $2,500 per month of salary, and employment passport, which is for professionals, has a minimum salary requirement of 4,500 Sing dollars a month, and these usually last for up to 2 years. There is, however, some additional wrinkles to the issue of foreign labor now in Singapore. There is a fair consideration framework in place for the employment pass, which is meant for your professionals. So what that really means is that if you do want to hire, you know, a professional in your Singapore company, then what you need to do is to advertise that job to the locals first before you're allowed to hire someone from overseas. And it's a low protectionist, I know, but it's the way it is. And the other thing would be the S pass, which I was talking about, the lower level S pass. There is now a quota for it. So, you know, a company can hire up to 13% of its total workforce for the service industry on the S pass, and 20% in all other industries. So that's something for businesses to bear in mind if they do want to hire foreign labor.
So, Till, what about Thailand?
Thailand is actually super complicated. There are many different regulations. It depends on very on many details what work permit you can apply for. So I just want to focus on two main topics. One is also this emergency work, so-called emergency work permit, which is for installation and repair. You get this up to 2 weeks, one time extendable for another 2 weeks. That's it. That's often too short for projects. And this brings me then to the challenge in Thailand. You have, based on the minimum capital you have in your branch, the number of work permits you can get is limited. You need 3 million Thai baht and 1 Thai employee to get 1 work permit. So if you have 10 million baht minimum capital, that means you get maximum 3 employment work permits. This often is a problem in high-tech projects where you need a ton of foreigners coming in. And the only way around I found so far is actually employment agencies like Manpower or so. Pretty expensive, but this is, at least it's a workaround which works here. Wolfram?
Yeah, so this is about foreign labor, everything. And we come to the taxation of the labor.
Thank you, Wolf. I'll try to shorten it as much as possible to fit into the remaining time. So we might just skip some of the questions I had prepared earlier. So again, we'll now proceed to discuss the taxation of employees assigned in foreign countries, such as here in Southeast Asia. This topic covers broad subject. Some of this we have summarized, as you can see in the slides, and which we will be discussing as we go along. Actually, each host country has its own set of rules in the determination of taxation of foreign employees, as well as with respect to the compliance requirements. But there are common factors used as reference in the taxation of the individuals. Among these are also included in this slide. Let me skip the residency status. I'll go to the source of income rule. Because one of the factors that affects the imposition of tax on foreign employees is the source of income. I'd like to note that all of the countries represented in this panel impose tax on income source in the respective country, and income is considered source in the country when the employment services are rendered there. There are, however, some minor deviations or variations to this rule. So at this juncture, may I request my colleague Dinesh of Malaysia to explain to us the concept of incidental duties performed outside Malaysia in relation to the income taxation of individuals.
Thank you, Fulvio. So the way it works in Malaysia is that we do not tax employment income unless the employment is exercised in Malaysia. So we do not give any regard to where the contract is entered into, whether the payment is to a Malaysian bank account or a foreign bank account, whether the remuneration is denominated in Malaysian ringgit or a foreign currency. All those factors are irrelevant. The core factor that we look at is whether or not an employment is exercised in Malaysia, as in physically on Malaysian soil. One of the few exceptions to that is where works are performed outside Malaysia, but incidental to the jobs in Malaysia. So let's take an example. If we have a Malaysian company that has obtained a project, an installation project in, say, for example, Vietnam. And for that purposes, some employees of the Malaysian company are sent to Vietnam for a period of 3 weeks to do some work for a client there. So during this 3 weeks period, the employee is not exercising employment in Malaysia, but nevertheless, they're exercising duties outside Malaysia, which are incidental to their duties in Malaysia, and hence the entire month's remuneration will be subject to tax in Malaysia, including the 3 weeks in Vietnam. This is quite consistent with the international tax principle. However, if the staff is seconded to Vietnam for a period of 6 months, then depending on the facts, the income may not be subject to tax in Malaysia, even if the remuneration is denominated in Malaysian ringgit and paid to Malaysian bank account. So that's where our territorial scope may vary slightly from other jurisdictions that have derived a remittance or worldwide scope.
Thank you very much, Dinesh. What about Singapore? I think you have the concept of uptime apportionment of income, which is practiced there in Singapore. Can you talk about this, Irving? When is the employee entitled to such apportionment?
Yeah, so it's going to be a little short because the government has kind of like removed this after this year. So this is the final year you can apply for the time apportionment. It usually is on approval basis for a period of up to 5 years. If you're a foreign employee working in Singapore, you have not been resident in Singapore for the past 3 years, then you would be entitled to apply, whereby the part of your income, a time apportioned amount of your income that is attributable to you performing your employment services outside of Singapore will not be taxable. Otherwise, under normal rules, the entire employment income will be taxable in Singapore. So now that's, as I mentioned, the government has removed the scheme, so it's not going to be available after December 31st. So the last successful applicants will be able to do so for up to year 2025. And so that's something which is going to be of the past.
Okay, thanks, Irving. Dinesh, can you go to the next slide? Let's go first to the application of the double tax agreements. While each country has its own domestic laws defining the taxation rules in the respective country, these countries had also concluded DTAs or tax treaties with some other countries. And those DTAs include the rules on the taxation of individuals, including the possibilities of exemption from tax in the host country. There are, however, some challenges that are often met in the application of these tax treaties. And may I request my colleagues from each of the 5 countries to discuss any issues, concerns related to the availment of benefits under the double tax agreements. And let me start with Indonesia, followed by Malaysia, Singapore, Thailand, and Vietnam. Brief discussions, please. Thank you.
Thanks, both of you. With regard to the tax treaty, the Indonesian Tax Authority has issued guidance in applying this tax treaty. They require a certificate of tax residence to be supplied by the non-resident, what so-called as DGT Form 1. This tax resident and the questionnaire regarding the beneficial owner of the income recipient is required to be submitted by withholding tax agent to the tax authority in a monthly withholding tax filing. So having this requirement fulfilled by withholding tax agent, the Indonesian Tax Authority generally respect the tax treaty and they will accept the reduced rate or relief as stipulated by the tax treaty. That's more or less a summary of the tax treaty in Indonesia. Can I move to Tanes from Malaysia?
Yeah, so we are generally complying with the tax treaty, especially on the labor part. There's no application needed, just that when there's an audit, you would have to produce the certificate of residence upon request as part of the audit processes. But we also realize some issues arises due to timeline. For example, we have a lot of projects that come in from China, and personal income taxes in Malaysia are due to be submitted in April, and the tax returns are not made available for submission sometimes by end of February. So you really have that 2 month window to submit. So the practical issue is if the other country, the resident country requires tax receipt to be submitted to claim bilateral credit, and if their deadline is earlier than our opening date, which is end of February, you will have practical issues of being entitled for DTA in the other country. But in terms of Malaysia itself, we are quite friendly in honoring the DTA obligations. Over to you, Fulvio.
Yeah, can we proceed, Till?
Yes, thank you, Fulvio. Thailand is actually, for a change in this respect, pretty simple. It's a self-declaration system. So basically, you make an assessment what tax you have to pay. You apply the DTA if you're wrong, if you applied wrongly, and it's found out by the authorities, and you just have to pay a penalty. So, but basically, you don't need to apply for any waiver or anything. It's all self-declaration based. In general, you only need to anyways pay taxes on local income, not on international income, offshore income. So it's actually simple and very, very efficient. You just make your calculation, submit it, that's it.
Thanks. Still, Irving, please.
Sure. So I guess, yeah, we generally honor, the treaty obligations. So what you need to produce is really what we call certificate of residence that's issued in the name of the recipient country. There are some requirements, technical requirements. It has to be in English or accompanied by an English translation. It must be certified by the tax authority itself, and that clearly states that the company is resident in the foreign jurisdiction. It has to be clearly state the year for which it was resident, and you don't need to submit an original document. You just need to submit a copy online. And for non-resident professionals, there's a form that needs to be signed by the non-resident professionals, but that doesn't have to be submitted at all. So generally speaking, yes, we do honor our treaties.
Thank you, Irving. And next, Wolf.
Yeah, in Vietnam, this is a bit more complicated than operating a project. For paying the personal income tax, first the employer must check the residency of the employee, for which a copy of the contract must be obtained with all pages. And this is a big issue in many cases because foreigners do not like to show their passport to the employer for whatever reason. This is required, and a dossier on the conditions for the tax exemption or tax reduction of the employee must be filed together with the first tax declaration. This also is sometimes not done because companies and individuals are not aware that the tax year of the foreigner begins with the first entry, no matter for which purpose. And the first declaration is due after at the end of the month after the first quarter in which the foreigner is entering Vietnam. If this is done correctly, then of course the DTA is applied, but if the deadlines are missed, then it is becoming complicated.
Thank you very much. Thank you all. That concludes our presentation on this topic on taxation of foreign employees. Back to you, Laura.
Thank you very much, Fulvio, for leading this last topic. This in effect concludes our presentation and brings us to the Q&A session, which will be moderated by Tanesh. Tanesh, can you take over?
Thank you, Till. Thank you, everyone. Okay, so I have a few questions here. We'll try and answer as much as we could. First, for you, Till, can I get an import license in Thailand if I only run a branch of a foreign company?
If you register the branch office, it's not a problem. You can get the import license like if you had a company limited. The problem is only if you don't run. If you don't register, if you just send people in, then you have a problem. But as soon as you have a registered branch, you have access to all import licenses and other licenses like a local company.
Okay. Next is for you, Fulvio, in Philippines. Understand for TTRA application to avail of tax treaty benefit, one of the documents required is an original copy of a certification from the Philippine Security and Exchange Commission that the income earner is or is not registered to engage in a business in the Philippines. How will this work when the company itself has no business presence in Philippines? Does it need to apply to SEC for a confirmation of no business presence?
Thank you for that answer. For that question, it's in fact absurd to be getting a certification when in fact there's no company registered here with the SEC. But we actually apply. Yes, we do apply even if there's no registered company or entity. We apply for negative certification. That is, the SEC will issue a negative certification, essentially saying that nothing, there's no registered company or even a related company here in the country. So it's a negative certification, not a certification, but a negative certification. Thank you.
Thank you, Fulvio. Wolfram, for you in Vietnam, is it necessary to have a construction license for construction supervision services? Construction supervision services.
The definition of construction business is very broad, and construction supervision is included. So for operating this, the license is required. Yeah.
Okay. I think there's a question in relation to Singapore, but this is not really a tax question. The question here is that if a Singapore entity enters into a contract with a Thai entity, does the Singapore entity have the right to sue the local Philippines entity? And what would be the governing jurisdiction and whatnot, and which law would apply? This is not a tax question per se, but Irving, would you like to shed some light on this?
Sure. Yeah, I think it's a practical issue. A lot of times in your contract, you would want to state where you would resolve any disputes, and that's the forum clause. You can say that you want to do Singapore arbitration. You could also have a governing law provision that says that you want to be governed by the laws of Singapore or the other jurisdiction. You know, it usually depends on whoever is drafting the contract. So if a Singapore lawyer who's drafting it, we typically want to refer to Singapore law. And obviously there are certain benefits to clarity of certain issues under contract law. We might want to choose one jurisdiction over another. But as a practical matter, sometimes you may not want to have, you know, there are two issues. One is if you were to, you know, the person you're claiming against is actually in another jurisdiction, having a Singapore court award damages against this person, that's an issue of enforcement. Then you have to then present the court ruling from Singapore in the other jurisdiction, which might not be necessarily the most efficient process. And so sometimes there might be the practical issue of how are you going to make sure that you're able to effectively enforce any kind of judgments against them. Sometimes that will also mean that practically speaking, in your contract, you might not want to withhold payment of the service fee until you are satisfied that it is done, or keep it in escrow until the services, the conditions have been met, then you release the money to the service provider. So these are a few practical considerations.
Okay, there's a follow-up question on that, Edwin. Can we have a situation where the governing law is Philippines law, but mandatory arbitration in Singapore?
Yes, you can. So arbitration, you can do the law of any jurisdiction, right? I mean, the whole idea is that arbitrators, we just have to appoint arbitrators who are familiar with the laws of those jurisdictions. So it's possible. It's just that I haven't, I mean, maybe not Philippines, but I've seen a lot of New York law, and then it's like Singapore arbitration. I've seen those before.
Tanish, may I just add something, because this is something which is coming from my heart. I did it because this arbitration is now, everybody's putting arbitration and thinks this is solving all the problems. It is, yes, it is a tool because you can execute those the arbitration awards in other countries, but it is very, very expensive, and you have to think about it if it makes sense for the contract value and the potential damages that you go to arbitration or not. So what we currently actually suggest is, yes, arbitration, but with an opening clause to go to local courts for smaller claims. Otherwise, you cut yourself off from smaller claims. This I just wanted to add to this question.
That's a great point, Till. Fulvio or Wolfram or Tommy, do you have anything to add on to this point?
Yeah, I just want to confirm, I think what the others said. In so much the application of the arbitration rules of other countries here. We normally include those in the contracts if it usually involves two parties, one from other country and one from the Philippines. They can agree on which arbitration rules will apply, and they can include that in the contract, and that will govern the arbitration in case that is needed. Thank you.
Okay, thank you. Another interesting question here. This is somewhat related to transfer pricing, withholding tax, and so on, double tax agreement, if you like. But the scenario is very simple, right? We have a project. Let's say I'm from country X. I have a project to deliver in country Y. and hence there's a PE, permanent establishment, in that country. Why? And what I'm going to do is, because there is everyone on the ground in country Y are technical people. There's no one with managerial, no one to do accounting, HR, and all those stuff. So for all those stuff, from country X to country Y, we charge a management fee. So how would this work out from transfer pricing, withholding tax, and DTA perspective? I think in most countries, not all, that services performed outside that particular country, right? So if you're country-wide, services performed outside country-wide would not be subjected to withholding tax. And hence, there's no withholding tax concern. But when there's an audit transfer pricing, usually this is an area that is well scrutinized, management charges to a permanent establishment. That's this experience in Malaysia, and I think that's also a common experience. I invite the colleagues from other jurisdictions to comment on this. Maybe starting with you, Irving.
Yeah.
Irving?
All right, looking for my unmute button. So yeah, generally speaking, I think management fees are fairly common. So what you really need to do is ensure that you have a proper benchmarking done, so that often we do have some kind of safe harbor rules. So if the kind of services that we are talking about are fairly routine, then you might want to do a cost plus 5, which countries might encode into the tax legislation and say that as long as you follow cost plus 5 methodology, that is good enough. But one of the tricky parts about that is that those are really routine services, right? Like HR, like finance services. So if you're talking about management and something which is less routine, then that may not be covered by any safe harbor rules in your country. Yeah, that's my 2 cents worth.
Irving, how about the withholding tax? Would typical management fees be subjected to withholding tax or not in the case of Singapore?
It really depends. I think that it depends on, again, as I said, classification, right? So if it becomes classified as a royalty because of technical services, for example, then you have a withholding tax that applies to it. But otherwise, if it's services, generally service income will be taxed as profits of the permanent establishment. So that would not then be subject to withholding. It's just an allocation issue.
Okay, how about...
Can I comment on that, Dinesh?
Sure.
This is for you. Yeah. You are correct in noting those management fees issues regarding management fees, because here in the Philippines, the usual approach of the tax authority is to impose withholding tax. And that's wrong, because the taxpayer can always get away with it, precisely because the service is rendered outside the Philippines, which is not taxable in the country. I think what the correct approach there would be, yes, to question the imposition of management fee based on transfer pricing rules. And secondly, I think to question the deductibility of the management fee, because in some cases, actually, there are no services that are actually rendered. There's just an agreement between the foreign company, the local company, regarding the payment of management fees. But they cannot actually support the fact that there are management services that are actually rendered. So it can actually be questioned on the issue of deductibility, but definitely not on the withholding tax, because this is not subject to withholding tax. Thank you.
How's the case in Vietnam?
Management fee is a very difficult issue because, first of all, the commercial bank will challenge the documentation on the provided services, the contract, and so we have cases where companies try for 2 years already to get this paid. We recommend not doing it. And foreign contractor withholding tax is applied normally with 5% VAT and 5% CIT.
Okay. How about Indonesia?
Thanks, Dennis. I think it's more or less similar with the other country. From CIT point of view, the deductibility will be scrutinized, could be scrutinized based on TP principle, transfer pricing principle, what's the benefits, and so on. With regard to withholding tax, as long as the services are delivered in Indonesia or less than threshold as stated in the tax treaty, or delivered outside of Indonesia, it will be exempt from Indonesian withholding tax. And there will be 10% self-assessed VAT, reverse charge VAT need to be paid, and that VAT will be creditable to the output VAT. That's, yeah, more or less that's Indonesia.
implication for tax management fee.
Thank you, Tommy. I think this is a very rich topic that covers transfer pricing, CIT, withholding tax, and indirect tax as well. Till, I invite you to comment on this question and also to offer concluding remarks to bring this wonderful session to an end. Thank you.
Thank you very much, Dinesh. In Thailand, it's actually similar to Indonesia and Philippines. It's basically management fees are always a touchy topic. You have to be well prepared to defend them. So it is definitely something which may be raised by the authorities if it comes to it, and that there are more and more cases, even though there is no internal instructions yet how to apply the transfer pricing law, but I see more and more cases where those were challenged and where the companies were asked to prove that the service was in fact rendered, so that the service was worth what it was what was paid for, and also to submit the costs so that you can basically compare the costs incurred in the foreign country and what was charged back. Withholding tax is only applied if it's under the DTA applicable, which means similar like Singapore, if it's considered royalties, then yes. Generally, management fees are not considered royalties here, so there is no deduction of withholding tax because there's it's not rendered by a PE here. So we are unfortunately running out of time. We have a couple of questions left, which we will answer afterwards. You're going to get our contacts if you have particular questions to some of the speakers. You can also write to them directly. I thank everybody who participated in this session. It was really fun to hold it, and I found it very interesting to hear also about the other countries. It shows how complex those projects can be, and I hope that we could shed a little bit light on the different topics which are involved if you run a project like this. This brings me to the end of the session. Thank you very much again to all the participants, but also to the participating chambers. Last but not least, also thank you very much to all my co-speakers. I hope you had a great session. Stay safe. Thank you very much and goodbye.